Welcome to EconTalk, part of the Library of Economics and Liberty. I'm your host, Russ Roberts of Stanford University's Hoover Institution. Our website is econtalk.org, where you can subscribe, comment on this podcast, and find links and other information related to today's conversation. You'll also find our archives, where you can listen to every episode we've ever done going back to 2006. Our email address is mail@econtalk.org. We'd love to hear from you. Today is August 26th, 2013, and my guest is David Laidler of the University of Western Ontario. He has written widely on monetary economics and was the research assistant for Friedman and Schwartz's classic Monetary History of the United States. David, welcome to EconTalk.
I'm very glad to be here. Thank you for having me.
So I want to start with the Great Depression and Friedman and Schwartz's work. They had very revolutionary views of what caused the Depression and the failure of the economy to recover. What did they try to teach us in that book?
Well, let's first remember that book was from 1867 to 1960. It wasn't just about the Great Depression. What they tried to teach us about the Great Depression specifically was that it was a particularly extreme example of a pattern that you could see throughout American monetary history, namely that if you allowed the rate of money growth to collapse, you were going to bring about a downturn in the economy. More specifically, as far as the Depression was concerned, they argued that the Federal Reserve System turned a fairly routine downturn that started in 1929 into an absolute catastrophe by, first of all, failing to act to support the banking system in the first year of the downturn, and then just failing to take vigorous action to get the monetary system expanding again over the next 2 years, culminating in the bank holiday of 1933 and the raising of the price of gold and all the rest of it. So in a nutshell, the message was the Great Depression was not a sign that there was some deep flaw in the market economy. It was the Fed's fault.
And how have those arguments held up in the current crisis that we're in, this sometimes called the Great Recession?
Well, it depends on who you talk to. If you talk to Paul Krugman or read his blog, he's been very insistent that those arguments have been blown out of the water by the last recession. He argues that this time around the Fed did indeed react quickly and vigorously, and basically nothing happened. I think he's just wrong about that. One of the things that didn't happen, this time is that the money supply didn't contract by about 30% in the wake of the financial market crisis. The price level didn't fall the way it did in the early 1930s. The inflation rate went down to around about zero, but it stabilized. And though the first year of both crises in terms of the contraction in national income and the impact on the labor market look very alike, at the end of the first year, things stabilized this time around rather than spiraling on down for another couple of years. So I think this time around we got pretty much what Friedman and Schwartz's analysis would have led us to expect. Now, that's not to say that the Fed couldn't have done better this time around. I think in hindsight, people like me might argue they could have been even more expansionary, but that's another story. And of course, there's another part of the story that you had fiscal stimulus as well this time around, which you very much didn't have in the 1930s. So there's always an issue of sorting out just how much to attribute to monetary policy, how much to attribute to fiscal policy, all those old debates that have been going on since the 1930s on and off.
Just ask you one question about that. Hoover gets blamed for being a do-nothing president, but government spending did rise during the Hoover administration, correct?
Yeah, no, Hoover got a very bad rap. I mean, he really did. People forget that Hoover, when he was Secretary of Commerce, was a big supporter of the National Bureau of Economic Research's data collection and business cycle analysis programs. And Hoover's aim was actually to put in place a system in which the federal government and the U.S. could deploy countercyclical fiscal policy. And indeed, when the Depression first came, that was what he wanted to do. The trouble was the collapse was so prodigiously fast that what was available for the Feds to do was just by no means big enough. But, you know, the Friedman and Schwartz argument is then relevant here. Basically, the rather puny fiscal efforts that Hoover was trying to make were just undermined by the incompetence of the Federal Reserve System.
So coming back to the Krugman criticism, and he's not alone, of course, many people have argued that because of the lower bound of zero on nominal interest rates, that the Fed is impotent, that it can't really do anything. What's your response? And you've argued that they've actually been somewhat effective. They could have been more effective, but they forestalled a disaster. What's your view on this issue of the so-called liquidity trap, the idea that the Fed can't really affect any monetary policy as interest rates get as low as they have?
Okay, let's just get one thing in the history of economic analysis straight. This is not really an argument about a liquidity trap that Krugman and people are putting in the traditional Keynes sense. It's an argument about what Ralph Hawtrey in the 20s and 30s called a credit deadlock, a state of affairs in which the business sector was so depressed that it just wouldn't borrow from the banking system. And because it wouldn't borrow, credit didn't expand. And because credit didn't expand, the money supply didn't expand. Now, Hawtrey and other people in the 30s were arguing, well, when that happens, the Federal Reserve System has got to be proactive. It's got to go out there and buy securities, buy long-term government debt, buy anything that's there, and just stuff the banking system full of reserves until it starts lending actively on its own account. And I would argue that policies like that have been available this time, that the zero lower bound is a problem for conventional everyday monetary policy that focuses on the overnight rate, but it's not an insuperable barrier to monetary policy when an economy is getting into trouble. It's just something you've got to take account of, and you've got to do other things. And I do wish people wouldn't call these policies unconventional, because they're not. They've been in the economics literature for nearly 100 years.
Do you think Friedman would have been an advocate of quantitative easing in that, along those lines?
Well, I want to be careful here because, you know, Friedman is not with us. And the guy that imaginative, you're never quite sure what he would have said this time around. I think what we can say is that his analysis of the Great Depression and his analysis of Japanese issues, you know, in the 1990s and round about the year 2000, 2001, he certainly was in favor of what we now call quantitative easing in those cases. I'd like to think he would have been in favor of it this time around, but I say you have to be careful. A striking feature of the recent debate was, for example, that the late Anna Schwartz, early on in this recession, was actually very critical of the Fed. That surprised me, but she was. So you can't count on these things.
Yeah, I want to come back to we're going to get to the criticisms of the Fed from monetarists, which has been, of course, very interesting. Right now we're talking about the criticisms of the Fed from the people who are more advocating fiscal stimulus. But my question is that you're suggesting that zero lower bound is not so relevant because the Fed can go out and buy assets and inject money directly into the banking system, that the interest rate issue is not so important. But how do you reconcile that, given that you give the Fed decent marks, with the fact that so many reserves have piled up in the banking system and there seems to be so little expansion of credit?
Well, first of all, since 2011, roughly speaking, money growth has picked up in the States. Let me refer to another monetarist economist, Philip Kagan, who did a lot of the background work for the monetary history of the United States. The way he put it was this: when people looked at the U.S. after 1933, many people argued that the Fed was expanding the reserve base, the money supply was growing a little bit more, but all of this was like pushing on a limp string. It still didn't get the economy going. And what Phil Kagan said was really not so. The right analogy is pushing on a coiled spring. And you start pushing, and first of all, the spring starts to compress, and nothing much happens. But as you keep on pushing harder and harder and for longer and longer, eventually the other end of it begins to move. And I think we've been seeing that happening in the U.S. this time around. It's been remarkably consistent with the later 1930s, I think. I wish that, QE3 was perhaps a little more vigorous because money isn't growing quite as fast as one would like to see it. It's stuck somewhere in the 5 to 10% per annum expansion range, depending on which aggregate you look at. And I think the economy could stand a bit more of that. But things are now moving in the right direction. There is a recovery underway. It's not all that vigorous, but all the signs are the economy is coming around, and it's doing that in the face of some fiscal contraction as well, which I think is quite striking.
Now, on this program in the past, Steve Hanke has argued that using broader-based measures of money other than M1 and M2, that growth remains well below its trend, the growth of the money supply, and that despite the expansionary aspect of the Fed, it hasn't offset the contractionary aspect of the shadow banking system's collapse and the regulation of that system that's contracted the supply. What are your thoughts on that?
Well, I think that, I'm not an expert on the day-to-day workings of the U.S. monetary system right now, but I think there's probably something to that, and I think it's quite consistent with my own judgment that the conventional aggregates M2 is not all that narrow after all. There's quite a lot of assets in there. That could be more vigorous without putting anything very much at risk. I know Steve Hanke likes those things called divisia aggregates.
Yeah, that's what he uses.
Yeah, I use divisia M4. Now, a divisia aggregate is one in which you weight the rate of growth of the particular component by its liquidity. Right, so if it's a very liquid asset, you give it a bigger weight.
It's more money-ish.
It's more money-ish. And you measure its degree of money-ishness by the difference between the rate of return that's paid on that asset and some representative market rate of interest. Now, all those spreads have narrowed, okay? And what the divisia aggregates are showing is that the rate of growth of, shall we say, M1, those demand deposits, transactions money, is not getting the amount of weight in those broader aggregates as it usually does, because the difference between the zero rate of return on that kind of bank liability and overall market rates of interest has shrunk. My general take on monetary aggregates is that there's no reason to suppose that one aggregate is going to tell you the story all the time under every historical circumstances. You need to keep an eye on a range of monetary aggregates. And if they start telling you different stories depending which one you're looking at, then the next step is to go into the data and try to find out why. I don't think there's mechanical rules here to apply to policy. So I wouldn't want to argue with, that's a long answer to a short question. I wouldn't want to argue with Steve Hanke about this. He's closer to the data than I am, and as far as I can see, what he's saying is consistent with what I've been saying.
And that's just a way of explaining the slowness of the recovery relative to the depth of the shock.
That's right. I think I've certainly been surprised at the amount of quantitative easing that the Fed has had to carry out to get the monetary system moving again. And as I say, I'd like to see it moving even faster, but I'm not sitting in the policy chair wondering how I'm going to unwind all this eventually when the economy comes around. But I don't think that's a problem for next year. I think we've got a way to go yet.
It's a rare moment of honesty from even an EconTalk guest. I appreciate that. I want to go to a question that I've asked many times to different guests, and I appreciate my listeners' patience, but I think you actually have a lot of insight into this question relative to some of the people I ask, and that's the following. I was trained, as you were, at the University of Chicago, and I was taught that when you think about monetary policy, you think about quantities. You think about the quantity of money. Now, you might debate or be unsure, as you just alluded to, as to which definition, which aggregate measure is the right one. But we were told to look at quantities. You want to understand the impact on the nominal economy. You want to look at the impact of monetary policy on inflation. You look at money, the quantity of money. And yet, over the last 10, 15, 20 years, the chairs of the Fed, plus many monetary economists, always talk about interest rates. What's going on there? Why is there two different approaches? And help me understand that.
Well, what I think happened was that people like me in the 70s and 80s overstated the case for the reliability of the rate of growth of the money supply as the anchor for monetary policy. Things didn't work out as well as expected in a number of places. You also had, Milton Friedman's really catastrophically bad call at the end of the VOCA disinflation. The double-digit inflation was just around the corner again. And central banks were put off relying on money growth. And I think they threw the baby out with the bathwater. I think money growth targeting wasn't a very effective policy framework. But I don't think that was a good reason to stop looking at these variables altogether. But a lot of people did. And parallel to that, of course, you had developments in monetary theory starting in the 1980s, 1990s. The big names there, people like John Taylor and Michael Woodford, Lars Svensson, who started building models of monetary policy in which they simply cut out the financial system altogether and just concentrated on direct links between policy interest rates and the level of spending in the economy. That kind of model works just fine when the monetary system is functioning. When the monetary system is functioning, you can ignore it. And I'm afraid we had about 15 years when leading scholars of monetary economics just cut the monetary and financial system out of their analysis. And that's been a shame. I hope that one beneficial side effect of the last few dreadful years is that people will start paying attention to those monetary aggregates again. Just as a side remark, in Europe, the European Central Bank had a reference value for the rate of growth of M3 as a sort of backup to its regular policymaking framework. And for reasons that are quite beyond me, this reference value has disappeared altogether in the last 3 or 4 years. Money growth has been incredibly sluggish in the EU. And look at the stagnation in that economy. I don't think that's an accident.
Is there a parallel in the U.S. economy? I remember after I interviewed Milton in 2006, I questioned him about one of his claims about the Great Moderation, which we, of course, were at the tail end of at the time. We didn't realize it. But it was one of the thrills of my life that a 90-plus-year-old economist, I think Milton was 92 at that point, sent me a spreadsheet. And he said, you don't want to look at M1, you want to look at M2. And
that's right.
M2 was very, very steady, as he had essentially claimed. But it hasn't really has M2 reflected this crisis that we're in?
My recollection is that it did indeed. That its growth rate really went into a bit of a spin in 2000 after the collapse of Lehman Brothers. But that in the last little while, it's got back again. Yeah, I've just got this up on my computer screen just to check. And M2 at the end of 2008 was actually growing for a little while, close to 10%. It just peaked. And then it went into a spin and its growth rate almost got down to zero by early 2010. And then the growth rate's been coming back since. So what you don't find in the U.S. monetary aggregate data is any sign that there was going to be a major downturn starting in 2008. There's no big contraction in money growth before the downturn started. That's one of the mysteries about this particular episode. But once it got going, you got this spiraling downwards. And as I say, this time around, unlike the 1930s, the Fed's expansionary reaction to that put a stop to the contraction before it gathered too much momentum.
Yeah, well, obviously there's a cause and effect issue in monetary policy, especially when it's linked to a financial crisis. And as you point out,
that's right. I mean, the process is a recursive one, right? Monetary tightening causes the economy to contract, and a contracting economy, if you don't watch it, starts making the money supply contract even further. Well, and that's what was going on there.
And I would say, especially if it originates in the financial sector, and there's some debate about. You allude to it in some of your recent writing about what I would call the real side or the microeconomic side, and you point out that the Austrian view, the idea that both the 29 collapse and the current mess did see a very rapid run up in asset prices that suddenly collapsed, and that obviously caused some challenges for the financial sector.
Yeah, I mean, that's right. I mean, people keep calling these things financial crises, and they're really asset market crises, and they happen on the margin between, markets for financial assets and markets for real assets, like real estate and factories and physical investment. I don't think the monetarist story of the onset of the Great Depression, by the way, or the monetarist story of the onset of this Great Recession is quite plausible enough. I can't find anything in the data in the 1920s or the data in the run-up to this event that shows a degree of sort of conventional tightening of money growth that can account for the speed of the subsequent downturn. That really looks like, in both cases, an economy where something was going badly wrong in real asset markets, and it just needed a little bit of tap from the financial markets to set a downward spiral going. And you're right. I mean, the Austrians were the pioneers of this kind of analysis in the 20s even. And, of course, there are still Austrians around. And if I may sort of put in a plug for Cambridge, England, where John Maynard Keynes was, Keynes's colleague Sir Dennis Robertson was developing a parallel analysis to this in the 1920s. And he wrote a little textbook, and its 1928 edition has got a couple of paragraphs expressing his fears about what was likely to happen in the States if that asset market boom kept on going. And this was before the Great Depression and before the stock market crash. In contrast, the sort of the representative of monetarism in the United States in the 1920s was probably Irving Fisher, and Irving Fisher didn't see anything coming. He was just concentrating on the behavior of the price level and saying, all is well, right down to the to October 1929, and indeed afterwards. So I think we got to give the Austrians and Dennis Robertson some credit, and I'd like to see our profession start taking that analysis a little bit more seriously. I mean the mainstream of our profession, because, of course, the people who have been propounding it are certainly professionals themselves, but they're in a minority.
Yeah, I think the biggest challenge is you refer in one of your working papers, and we'll put a link up to this. It's a very nice paper. You refer to monetarism without money. Meaning this focus on interest rates. And I would phrase that a little bit differently, which you alluded to a minute ago, which is macroeconomics without the financial sector seems to be not a good idea. The division of labor is limited by the extent of the market. And as economists have gotten more successful and there's more of us, we've specialized a lot. It seems to me macroeconomics needs to try to integrate that a little more successfully.
Oh, I think that's right. I mean, let me give you a sort of quick take on what I think happened. We talk about a market economy, and we talk about markets determining prices and allocating resources and all the rest of it. And if we go to the world we live in, what we see is that when we look and see how markets actually function, it's we exchange goods and services against money or in credit transactions, and money passing from hand to hand, credit transactions among agents are absolutely fundamental to the way in which the markets work. Fair enough, but we can't model the monetary and financial system every time we try to address an economic problem about the effectiveness, shall we say, about tax policy or the desirability of a free trade deal with some other country. So we abstract from it and we talk about the market functioning. Now, that kind of analysis, that's microeconomic analysis, has been enormously successful. And one of the big movements in macroeconomics in the last 30 years has been to use that kind of microeconomics as a basis for macroeconomics. Well, my take on that has always been is that abstracting from the monetary and financial system is all very well for many problems, but not for the problems of the macroeconomy. And you've seen a lot of people trying to put monetary and financial factors back into this kind of model of the market economy, not realizing that it's already in those models, a tacit assumption that the monetary and financial systems are functioning all very well, thank you. So they're trying to put the monetary and financial system into the same model twice with different assumptions about the way it works. And, you know, it comes out as a bit of a mess, and I think that's where we've been.
Before we move on, do you want to say anything about the decision by the Fed to pay interest on reserves and why you think they did that and if it has any significance?
I mean, if I remember that Milton was in favor of paying interest on reserves way back in the 1950s with his program for monetary stability.
What was the argument? What was the argument he made for it?
The argument was sort of was that if you paid interest on reserves, you would give the banking system less incentive to try to evade reserve requirements, and hence you would give the Fed more control over the behavior of the monetary aggregates. That was the essence of Milton's argument. The other argument for it that became very popular in the 70s up here in Canada, at least, is that forcing banks to hold non-interest-bearing reserves was putting a tax on banks, and there was no particular reason for taxing those institutions. So pay them interest on reserves and relieve them of that tax. The way we went in Canada was the opposite direction. We just phased out reserve requirements, and essentially we've got a monetary control mechanism that no longer relies on the reserve base. But that's a different story, and it's not a story that's 100% relevant to the way things work in the States. I'm sorry, I haven't really given a straight answer to your question.
Well, let me ask it a different way.
I haven't lost any sleep about the Fed paying interest on reserves. I really haven't. But I do notice that it makes the banks more willing to hold the proceeds of quantitative easing without getting out into the market and making loans. And I wonder if the Fed paid quite as much attention to that side effect as it deserved. But that's a technical detail in the execution of policy and takes us back to, has policy been expansionary enough?
Yeah, well, but it's a nice segue to the next topic, really, which is some of the criticisms of the Fed that have been coming not from the fiscal side, but from monetarists. I'm going to read a quote from a working paper of yours and talking about criticisms of the Fed. Quote, that it has exceeded the bounds of its responsibilities as lender of last resort by rescuing insolvent investment banks and insurance companies rather than limiting itself to providing liquidity to solvent commercial banks, that by cooperating with the Treasury in many of these activities, it has surrendered its policymaking independence, and that the massive increase in its cash liabilities that has resulted from these policies and subsequent quantitative easings carries with it a serious inflationary threat. So I want to take when we take these one at a time.
Okay, and be clear. I was trying to paraphrase people I was disagreeing
I understand.
with.
That this is not your view, but this is I thought it was a fabulous summary of what many people have said, accused the Fed of. You're going to defend the Fed against most, if not all, these charges. Let's start with this one of traditionally, where tradition goes back to I suppose Bagehot. Who said that the Fed should be the lender of last resort, but only to solvent banks. It shouldn't be propping up insolvent banks, and yet the Fed seems to have propped up everybody once Lehman Brothers failed.
Well, first of all, Bagehot didn't say that, okay?
All right.
If you comb, Lombard Street on your computer and look for the word solvent, you're only going to find it in one place. And he's talking about Britain being solvent in a case of a balance of payments crisis. So Bagehot really didn't say that. He said some things about you probably don't want to bail out really badly run institutions, but he thought that that was a minor problem. I think something that people have forgotten about these principles of the lender of last resort that we inherited from the 19th century. When Bagehot wrote Lombard Street, there was no limited liability in banking. Okay, the banks were partnerships or they were joint stock companies, but there was unlimited liability on their owners. So the notion of an insolvent bank in 1873 was a very different thing to a notion of an insolvent bank now. Okay,
it's a good point.
It's a family. It's a family business. The family has to be broke before the institution is insolvent.
But it doesn't change, and I appreciate what you wrote.
Yeah,
you wrote that the world changes and Lombard Street doesn't exist anymore, so we need to be thinking about this in a different way. And I certainly accept that, the logic of that. The problem is the way I understand Bagehot, whether I'm right, I apologize for misrepresenting him about the solvency issue. But basically, the thing that was appealing about that is that you don't want to be the lender of last resort to every bank, because if you are, there's a terrible moral hazard problem that banks will have an incentive to misbehave. Their creditors, more importantly, will have an incentive to lend imprudently. And seems to me we've gone down a very dangerous road, but you are more sanguine. What's your optimism?
Well, I mean, it is a dangerous road, but the whole, that's because, the financial system is a dangerous place when a crisis is beginning. The first issue is, can you really tell the difference between a solvent institution and one that's just lacking in liquidity when there's a run on it? Northern Rock, take an example. The first example in British history for heaven knows how long, over a century, of an institution that had customers lining up outside the doors to get their cash. Now, as far as I can tell, Northern Rock had a pretty good, solid portfolio of mortgages. There was nothing the matter with the mortgages it was holding. Its problem was that its supply of lending in the commercial paper market had just dried up as part of the worldwide commercial paper market collapse. And it was a classic issue of an institution being short of liquidity. But the Bank of England sat on its hands just for a little while, allowed this run to develop, and by the time they got everything settled with Northern Rock, the financial crisis had taken its toll, the economy had turned down, and what had started out as a liquidity problem for that institution did indeed turn into a solvency problem. But you can make a cogent argument that the reason it did turn into a solvency problem was that the liquidity problem wasn't handled early enough. A similar thing, argument can be made about the case of the Bank of United States in 1930 in New York, with the Fed let that one go broke, and yet they paid a pretty good proportion of their debts when their bankruptcy was finally settled in, I think, 1932 or 33. It's not clear that they were insolvent. They might have been illiquid. But the point is, it's difficult to tell the difference, and I would rather err on the side of making sure the financial system doesn't start to seize up. So I'm not too keen on a strict interpretation of that solvency, the liquidity solvency distinction. I would rather err on the expansionary side to keep the system moving.
Well, I take your point. I take your point.
I mean, a lot of people would disagree with me. I don't think it's the kind of thing that you can lay hard and fast rules down about. Similarly, whether you should stick only to banks. Well, there are two arguments about what the lender of last resort should be doing. The first is the traditional monetarist one, that the real object of the exercise is to stop the money supply contracting. So keep the institutions whose liabilities make up the money supply in business. There's another argument that says what's really important is the market for short-term interbank credit, because that's what oils the wheels of commerce and keeps industry going, and you've got to make sure that those markets don't get disrupted. That's the kind of argument that's associated with Ben Bernanke's work. But if you actually go back to the 19th century literature, you'll find both of these arguments around, even in the 19th century. And the second argument, the Bernanke-style argument in particular, which, by the way, was also partly Bagehot's, that's an argument that says you don't want to be too strict in drawing the line between what's an institution that kind of institution that you're going to rescue and what's the kind of institution you've got no business going near. Once again, if the collapse of a merchant bank or the collapse of an insurance company is going to impinge on the ability of the commercial banks to function, it's the job of the lender of last resort to make sure that doesn't happen. And again, there's a lot of precedents for this. The Baring crisis of 1890 in London evolved because Baring Brothers, who weren't a commercial bank, they were a merchant bank, were marketing Argentinian bonds in London. And they got caught with a big inventory of Argentinian bonds that they couldn't sell. And the Bank of England essentially organized a bailout of Baring Brothers by getting their creditors to hold off calling in their debts until the episode was over. It was a little bit like the way the Fed handled long-term capital management issue.
Thinking the same thing.
And, there was an eerie similarity. And that's a lender of last resort activity, but it's not the traditional, lend freely to only to solvent banks in order to stop the money supply collapsing. So there's a lot of precedents for these things.
So reminding myself, your warning or reminder earlier that we're not sitting in the policy chair. We're just having a nice chat on a late summer afternoon. It does seem that viewpoint, which I totally understand from a policymaker's perspective, err on the side of caution. Make sure that you don't let the banking system collapse. Once we're in that world, which I would argue is the world we've lived in for the last 25 or 30 years, we've created a situation where the large creditors of large financial institutions know that they are part of a complicated, tangled system. Now, we could debate whether that is the result of policy mistakes or policy decisions or whether it's just some natural progression of technology and globalization. Doesn't matter. That's the world we live in. In that world, the presumption is intervene. The presumption is lend. The presumption is rescue. The presumption is bailout. We're in a world where that sector of the economy is effectively being highly subsidized by this inevitable decision. It seems like a very unhealthy political economy.
Well, I think you say two things about it. First of all, to the extent that the monetary and financial system are public goods as well as made up of a lot of private sector institutions, there is a sort of traditional case for the provision of public goods with subsidies that comes out of welfare economics. I don't want to make too much of that. But I think one's got to distinguish among who actually gets bailed out in these operations. If financial institutions make dumb loans and look like collapsing, I'm 100% in favor of their shareholders losing all their equity, and I'm 100% in favor of the managers who made those mistakes being slung out on their ear. And if it turns out there's been fraud involved, being prosecuted and put in prison. What I would like to do is keep the network of credit markets functioning and stop the money supply collapsing. And I would have thought it was possible, in a rough and ready way at least, to devise a policy that does that. I mean, an awful lot of people lost an awful lot of equity by holding stock in the wrong banks in the U.S.
But they're the wrong people to look at. They're the people who rolled the dice, diversified. A lot of them made a killing along the way. Some got out in time, some didn't. It's the creditors who worry, the people who are the fixed income folks who worry about the solvency of the institution, not the equity people. The equity people don't want to be wiped out, obviously, but they get the upside. The creditors don't get the upside. If you take away the downside risk for them, the loss of bankruptcy and a haircut, and potentially a 100% haircut, we've got a very, seems to be, unstable system. And you alluded to the fact, an unhealthy system. You alluded to the fact that in the old days, banks were partnerships, and we've moved away from that. And I argue that's partly because we've subsidized moving away from it.
Yeah, but you can keep you surely can devise means of keeping the institutions functioning while having some of their bondholders take some fairly sizable haircuts. and stop the entire financial system collapsing. Look, I'm not arguing that moral hazard isn't a problem, okay? What I'm arguing is that when a financial crisis gets going, these things happen so fast. Policymakers have to make decisions. I would just assume they erred on the easy side, but I recognize the moral hazard issue, and I don't have a straight answer to it. I recall Charles Goodhart in England saying sometime in early 2009 that moral hazard is something we can worry about next year. For the moment, we have to keep the financial system functioning. And I think there's a lot to that.
Yeah, it's the road to hell, too, if you're not careful, right? It's the road
to... I take it. I mean, I've heard the argument made, and I don't have a straight answer to it, that, somebody had to be allowed to collapse, and it may as well have been Lehman Brothers. Okay.
Well, I think you said the right thing when you said there is a way to design a system that keeps some of the incentives, but for some reason, I think we know the reason, political reasons.
Yeah.
It doesn't seem to happen. I just, I'm not so much disagreeing with you as the tendency we have as economists to advocate what we think is the best policy and neglecting the fact that sometimes the way we want it implemented and the way it actually gets implemented is not the same thing. That's all.
No, that's fair enough. That's a fair enough point. And I won't pretend to have a straight answer to it because I don't. I really don't.
Let's go to the second part of your response to the critics of the Fed's behavior, which is to me incredibly interesting, especially given the history of monetary policy. Many monetarists, Alan Meltzer being one who I've interviewed on this program, who's said exactly what you were criticizing, have said that, well, this Fed policy of massive quantitative easing, the enormous buildup in high-powered money and the balance sheet of the Fed is going to cause huge inflation that's going to be very disastrous. We know inflation's a terrible virus once it starts to spread, and yet nothing has happened. They've been forced to argue, and I've been one of those people. I'm not an expert, but don't pretend to be one, but I still thought it was going to happen. We've been forced to say, well, it's coming. It's just a matter of time. What are your thoughts on that?
Well, I mean, first of all, I really don't understand particularly why Alan has paid so much attention to the behavior of the monetary base and so little to the behavior of the money supply during this episode. If we go back to Friedman and Schwartz and the story of the early 1930s, I mean, between 1930 and 1933, the monetary base actually expanded. Okay, not very much, about 2 or 3% per annum was the average rate of expansion. The money supply collapsed by about a third, and the economy collapsed. Now, that to me is devastatingly powerful evidence that what matters is the money supply and not the monetary base. This time around, we've had this huge expansion of the monetary base, and believe me, nobody's been looking more closely at the behavior of the money supply than I have to see when that was coming through and beginning to register an inflationary threat. But here we are, 4 or 5 years later, and it hasn't happened yet. Well, the people saying, it's going to happen eventually. Yeah, maybe it is going to happen eventually. If I may just deviate for a moment, my first senior colleague in monetary economics, my first job was Hyman Minsky. And in 1963, he was explaining to me that, a financial crisis was just around the corner. And eventually, Hyman Minsky was right. But it was, 50 years later, almost. They'll be right eventually. But I think you have to. I've asked Alan, and I don't think I've really had a very good answer. Why are you paying so much attention to the monetary base, and why have you been paying so little attention to the behavior of the money supply this time around? And, well, he tells me that the monetary base is the policy instrument, and policy is on that measure is extremely expansionary, and policies like that have always led to inflation eventually in the past. Well, maybe he'll be right eventually, but I see no sign of it yet.
Yeah, when I asked him, and this was a few years ago, so it still hasn't happened yet, but when I asked him at the time, his argument was that when the economy started to recover, those reserves that the banks were holding at the Fed would start to go out into the economy, and there would be terrible pressure on the Fed to let that happen at high levels because the economy would be recovering. It would be very difficult to tighten at a time when the economy is finally starting to recover. It hasn't quite worked that way. The recovery has been so mediocre. There hasn't been this sudden exhilarating whoosh of money and confidence.
I mean, there hasn't. You know, these are exactly the worries that the Fed had in 1937 when it doubled reserve requirements. There were lots of free reserves building up in the system, and the Fed was very nervous that it was going to lose control of the money supply as there was an expansion going on. They doubled reserve requirements, and what happened was that the banks that were subject to those reserve requirements immediately built up their stock of reserves again. That contributed to a downturn in the money supply, and that downturn in the money supply contributed to the recession of 1937-38. So I think there have been precedents for this kind of behavior, in the past, and I think that I'm glad the Fed hasn't followed Alan's advice this time around, and I'm frankly a little bit nervous even now about the sort of rumbling about beginning to phase out QE3. I hope they don't do it prematurely because we've been there before in the late 1930s.
What about John Taylor's arguments when he's been very critical of Bernanke. He was very, very critical of Greenspan in the run-up to the crisis, although that was ex post criticism. He was in the administration at the time of those decisions. And maybe was not so eager or comfortable being critical at the time, but certainly ex post, he's been very critical of Greenspan and Bernanke. What do you think of those criticisms and of the idea of a monetary rule that would be interest rate based?
Well, I mean, two things. First of all, I mean, I was critical of the Fed in those years as well. I thought the Fed should have raised interest rates a little bit faster in 2005, 2006. We did have an upward blip of interest rates here in Canada, which was separate from anything that happened in the States. And I think that just put a damper on the economy in the nick of time. And I wish the Fed had done that. And I did actually say so at the time. Not that anyone would take any notice, but so I think there's something to John Taylor's argument there. It boiled down to whether in the States you took the indicator of inflation as being the behavior, of the consumer price index, or you looked at something more esoteric like the core personal expenditure deflator. And the Fed were looking at the core deflator, and that, of course, because it's a core index, it takes out the behavior of food and energy prices, and it missed a fairly significant uptick in inflation, in fact, as a result. So I think there's something to John Taylor's argument about the Fed not having been careful enough in the run-up to this crisis. But that having been said, I still think you've got to look at something more deep going on in asset markets to explain the severity of the downturn. So
you think it's much more than just a monetary phenomenon?
Yeah, I do. I mean, I never thought I would live to say this, but on this particular instance, I'm inclined to line up with the Austrians. I think they really have a point about this issue, about asset market distortions after long periods of monetary stability.
Well, this again puts you in a small group of economists who've learned something from the crisis. I find it remarkable how many people have managed to keep their theological views unchanged by this experience.
Well, you must remember that I'm retired, so I don't have to worry about pleasing journal editors anymore.
Yeah, and yeah, well, no comment. What would be your view on going forward would be the ideal monetary policy? Should we be doing something like the Taylor rule? Do you think anything positive about Scott Sumner's approach and that of others who argue for nominal GDP targeting? Milton at one point, I don't know, he changed sometimes, but he argued for a steady growth rate in the rate of money. Where do you think we are right now?
Well, let me back up. The first let's think about a state of affairs in which we are out of the aftermath of the recession. So we're 2 or 3 years more down the path. I still am pretty happy with the inflation rate as the target of policy. I base this a lot on Canadian experience. We've been targeting the inflation rate since 1991. We've done it pretty successfully. We didn't have a big asset market crisis here. We had not had a recession, in fact, until 2008, since 1991. So inflation targeting worked pretty well for us. And it worked, I think, because it was a very explicit policy target agreed between the government and the Bank of Canada. It wasn't an informal thing as it was in the Fed. It was discussed continually, and as time passed, the targets were hit, and it gained in credibility. So I would see no reason to go from that to a nominal GDP target. I don't like nominal GDP as a target for policy for the simple reason is that's a variable that's measured with a lag, and it's subject to a lot of revision. And I don't see how you can run forward-looking monetary policy targeting the behavior of a variable that you don't get a good reading on for 18 months after it's happened, okay? With the inflation targeting based on a consumer price index, you get timely data and it's not subject to revision. The indices are not perfect, but they're well understood by policymakers, and the general public understands them as well. If I tell my wife the Bank of Canada is targeting nominal GDP, she'll just look at me and wonder what on earth I'm talking about. If I tell her they're targeting the rate at which the cost of living goes up, she understands that. And knowing that there is that target out there affects the behavior of ordinary consumers and producers, not just financial markets.
Yeah, I think that's very important.
So I'm a big fan of, first of all, that the target of policy should stay the inflation rate. Now, in the 90s, we developed this kind of policy model that John Taylor made huge contributions to, in which the central bank used its control of the overnight rate, the federal funds rate in the U.S. context, to target the inflation rate. And so long as the economy was running along fairly smoothly, that kind of model worked. I think we got the great moderation, as it was called, out of that kind of policy. And I don't think you can take that achievement away from people like John Taylor. But the trouble with that policy regime, if you think of it as a complete regime in and of itself, is that it's for fair weather. It's a policy that works so long as the economy is running smoothly and the shocks that come along are fairly small. But it's really bad for the kind of stormy weather that we've had in the last 3 or 4 years. The zero lower bound problem for interest rates is a big manifestation for that in that particular literature. These guys didn't really know what to do about it, and now they start talking about unconventional policies. So I think there is a role for a secondary policy regime as well, if you like, that goes back to Friedman and doesn't have a rigid target for the rate of growth of the money supply, but monitors the rates of growth of the monetary aggregates. And so long as it's not telling you anything different from your conventional analysis, well, you just get on with it. But when it does occasionally start giving you different information, you go behind the numbers and ask why, and maybe modify your policy stance if the monetary aggregates are telling you, giving you some extra information that isn't there in the interest rate-based model. This is messy and it's eclectic, but I don't think we can do much better in the current circumstances, quite honestly.
Now, you mentioned the Canadian experience. My impression is not only did you not have a recession between 91 and 2008, but that your 2008 experience was not nearly as drastic as the American one. Is that correct?
That is correct.
And it's also go ahead. Sorry.
Well, I was going to say, we did not have a big asset market crisis in Canada. We largely imported that recession from the rest of the world.
And isn't it also true that in the Great Depression, the Canadian economy did better than the average economy?
I don't have those numbers right in front of me, but the Canadian economy didn't do very well in the 1930s. I know that. What is true is that there weren't any bank failures in Canada during the Great Depression, but we had all the agricultural problems and we had all the backwash from collapsing export markets and things like that as well. So that's not an experience I would want to repeat.
No, but the bank failure part of it is rather. You'd think Americans would look and say, "Hey, here's an economy rather close next to us. they treat their banks differently than we treat our banks. Their banking system seems dramatically more stable. Stability is a good thing. We don't seem to copy you guys. Seems
we've got we've got 5 big banks and a few more smaller ones.
That's what we have. Our 5 are just bigger than yours.
Well, you're finally catching up with us. Okay. These guys have got a long tradition of nationwide branching. They are quite tightly regulated. I don't know what more to say. In part, Canada escaped this time around because we got a bit lucky. Okay, we did have a problem in the commercial paper market in 2007, but our mortgage market was much more controlled and regulated than the U.S. mortgage market. And in fact, the government was in the process of deregulating the mortgage market in the run-up to the Great Recession. It's just that the deregulation hadn't got far enough to do serious damage. And they spent the last 2 or 3 years re-regulating the mortgage market and putting things back where they were in about 2004. So I think we got a bit lucky. We also, I think, had some banks with good managers who, I remember hearing about the ninja mortgage from a senior economist in one of our big commercial banks, again, before the crisis. And he explained to me what a ninja mortgage was. And I said something like, well, I hope you're not going to buy any of those. And he said, you bet not. Well, lots of other financial institutions south of the border did, but by and large, our banks stayed out of that market. So combination of good luck, good management, and I'm not sure that you can, Canadian banking's got a 200 or 300 year history. I don't think you can export 200 years of the history of institutional development just like that. We didn't have Andrew Jackson as president, right?
Mm-hmm. Yeah, that's true. But I do see it as a public choice problem more than a paying attention problem. I think. If your realtors and home builders were as powerful as ours, maybe you'd have the government subsidizing home ownership as perilously as we have, and I think that's a huge part of the problem.
Well, our government does subsidize home ownership, of course, through a mortgage insurance program, and the mortgage insurance program was pretty tightly regulated, and they began to deregulate it. I think if the U.S. had taken another 18 months to turn down, we might have been following with a big collapse in the mortgage market, but it just hadn't got going. The problems hadn't developed far enough. I'm sorry.
No, let's close and talk about Keynes.
Okay.
When you were, we have a few minutes left. When you were in graduate school, Keynes was on the rise. Was the dominant Keynesianism was the dominant view, and you played a role as the role you played with that book, The Monetary History of the United States. You were a part of that counter-revolution that Friedman and Schwartz led, along with others. You mentioned Philip Kagan. Of course, there were many, many others. In a way, it started back with Irving Fisher, who was opposing Keynes before Keynes came along. But there became, during the beginnings of your professional career, a different view of the macroeconomy, of the business cycle, and monetarism became much more important, which was so dormant and so nobody paid any attention to it 5 to 10 years before that. And we're talking about the late 30s, 40s, and 50s.
Yeah.
So starting in the 60s with Friedman's work, he was certainly at the vanguard of it. In the late 50s and then the 60s and 70s, Friedman launched, with the help of others, a counter-revolution. What has happened since then? It's a rather remarkable, to me, seeming resurgence of the Keynesian viewpoint. What are your reflections on that, and what do you think has happened?
Well, first of all, just to go back to my own intellectual origins, it's very important to remember I did the history of economic thought both as an undergraduate and as a graduate student. So I had, for example, Lionel Robbins, who insisted that I read Henry Thornton's paper Credit, and I'd read Bagehot's Lombard Street. I had read some of the literature of the 1920s as an undergraduate and a graduate student. So I wasn't ever in a position to be persuaded that everybody had been talking nonsense before Keynes came along. Okay, maybe I had an unusual education.
He wasn't the first macroeconomist.
No, but I also read the Tract on Monetary Reform, which Milton said was his favorite book by Keynes. That's the quantity theory book that deals with the post-First World War monetary problems in a very monetarist framework, by the way. So, I knew that Keynes was one of these agile minds, and I don't know where he might have ended up. I know that his book, How to Pay for the War, was again very much in a monetarist tradition. He switched from his analysis of the world as always in depression to flexible mind. Now he said we have to worry again about the economics of scarcity and how to allocate resources in order to finance the war effort. And actually, Keynes's work on that was one of the roots of Milton Friedman's monetary economics. Friedman himself didn't know that. Friedman, when he was a young man, became aware of the 1941 British budget and its analysis of the inflationary gap and how to deal with that. And he didn't realize that was Keynes's budget. But he picked up that analysis and brought it into American debate, through his articles on the inflationary gap and things like that. Okay, I've sort of made a big detour from the second part of your question.
Fascinating. Keep going.
I think what's happened, what happened in the interim is that the monetarist counter-revolution never got really brought to fruition. What happened was that Bob Lucas and co. came in with rational expectations modeling. This was really a wonderful source of research topics for graduate students, and the whole profession went running with it and began to forget the kind of institutionally based empiricism that went along with Friedman and Schwartz in particular. It's remarkable that the most influential work of the monetarist counter-revolution wasn't a work of economic theory, it wasn't high-powered econometrics, it was a work of narrative economic history that dealt with the evolution of institutions and their interaction with economic experience. Well, all that went out of the board with this fancy rational expectations modeling, which had its benefits, but the monetarism faded into the background. Now, by the time we got down to 5 or 6 years ago, we had a framework called dynamic stochastic general equilibrium analysis, which is the basis of all those John Taylor-style policy models that central banks use, which literally was not capable of encompassing financial crises within its intellectual framework. Bob Lucas, himself said this in 2003. Well, we've got some really good models, but there's a residue of issues, was his phrase, they can't deal with, like the Great Depression and financial crises. Well, we've had to deal with those things, and some people like Paul Krugman, who were unreconstructed Keynesians, noticed there was time for a rematch, right, between their very old-fashioned brand of macroeconomics and another old-fashioned brand of macroeconomics called monetarism, and they've been leading that debate. And I'm not quite sure where the up-to-date mathematical guys are at the moment. I think they're desperately trying to integrate financial markets into those models and catch up. So the whole state of macroeconomics at the moment is very, very fluid indeed.
You're very honest about it. I think I think a lot of people I've read say, "Oh, yeah, this fits. I don't have to change anything." Some of those folks have Nobel prizes. I find that maybe not so surprising.
What I really find depressing is the way some of these guys, you must have heard the phrase that they're introducing financial frictions into the models, and this seems to me to be just bizarre. Just listen to what they're saying. We have a model of a smoothly functioning economy which we thought was adequate, and it turns out not to be quite adequate. Oh, there's a financial market, and that introduces frictions into the working of the economy. Well, that's bizarre, right? What's the financial and monetary system for? It's to overcome the frictions that are inherent in economic life, that actually it's there to make a market economy possible in the first place. So these guys, I think, have still got things upside down, which doesn't mean they aren't going to produce models that might be useful. I've been surprised often enough in that respect.
My guest today has been David Laidler. David, thanks for being part of EconTalk.
Yeah, you're most welcome. I've enjoyed it very much.
This is EconTalk, part of the Library of Economics and Liberty. For more EconTalk, go to econtalk.org, where you can also comment on today's podcast and find links and readings related to today's conversation. The sound engineer for EconTalk is Rich Goyette. I'm your host, Russ Roberts. Thanks for listening. Talk to you on Monday.